Hey everyone, today we are knocking out multiple pop quiz questions in a row. Starting right here with question number 1, Barbara Davis did a $70,000 Roth IRA conversion on December the 1st, 2025. Now, Barbara expects that she will be at a 24% marginal rate for 2025. So she sent in a Q4 estimated tax payment related to the conversion of 70,000 times 24% equals 16,800. Note that the payment was appropriately timestamped by the January 15th, 2026 Q4 estimated tax payment due date. However, after filing her return on April the 15th, 2026, the IRS hit her with a notice where she got dinged with underpayment penalties and interest. So what happened in this situation? What did Barbara do wrong? And for this first question and answer, let's assume that there are no other facts to be considered. So based only on the information given, what is the most obvious thing that Barbara did wrong? And the answer is that she forgot the default rule of the IRS when it comes to income. The default rule is that the IRS treats income as being generated pro rata, in other words, meaning evenly distributed throughout the year. Therefore, Barbara thought that her Roth conversion income looked something like this right here. Barbara thought that she had $0 of income in Q1, 0 in Q2, 0 in Q3, and then she had $70,000 of income in Q4. But that is not the IRS default rule on the treatment of income, is it? No, it is not. The IRS default rule is to treat all income pro rata unless you specifically state otherwise. So what the IRS saw was this: $17,500 in Q1, the same amount in Q2, Q3, and Q4. The $70,000 was viewed as being generated pro rata, meaning evenly distributed throughout the year. Now, question number 2. Okay, whoa, hold on there just a gosh darn minute. This, by the way, is Bill Fisher over here on the left, and Bill has a little bit to say about this estimated tax payment issue. He says, I had the exact same Roth conversion transaction in 2025 as did Barbara Davis. In other words, I converted $70,000 in Q4 and paid my estimate of $16,800 by the 1/15/2026 deadline, and I never got dinged for anything. Now I'm not complaining, he goes on to clarify. And that, by the way, is a good clarification, because many of you, like myself, were probably wondering, what in the world are you complaining about there, Bill, since nobody ever walks into the office and says, hey, I didn't get dinged by the IRS. Are you sure that you're doing everything right? Nope, nobody ever comes in and complains about that. So we were wondering what you were complaining about, but apparently you were not complaining. However, with that said, we are all happy that Bill is not complaining, but he would like us to make it make sense. Does the IRS just throw around dings willy-nilly? Is it all just arbitrary who gets dinged and who doesn't? How can two people with an identical Roth conversion transaction and an identical estimated payment made for that transaction end up with different ding results? Well, that is a great question that Bill has asked, and we are going to go over here to the Safe Harbor method calculators for both Barbara and for Bill, and we are going to compare the similarities and differences between them. But before we do, let's ask a few more questions just to make sure that everybody listening has all the basic information they need to understand the discussion that we're going to have inside the Safe Harbor Method calculators. So here are the next pop quiz questions for you, and I'm going to make them true-false, because I know everyone loves true-false since you have a 50% chance of being right every single time. Okay, starting right here with number 1, true or false, being sufficiently paid in under the Safe Harbor Method means the following. It means you have a combination of number 1, prior year overpayment applied, number 2, current year withholding, and 3, current year estimated tax payments. That Condition A has been sent to the government by January the 15th of the subsequent year, and Condition B is equal to at least 90% of your prior year's actual tax or 110% of your current year's estimated tax due. So I know that was a long question. Let's just summarize it. You have a combination of these 3 types of monies paid into the government, and the combination of all of them have been sent to the government by January the 15th of the subsequent year that you're dealing with, and they are equal to at least one of these 2 amounts right here. Is this true or false? And the answer to that one is false. Let's go through the explanation right here. Condition A is false because 25% of your safe harbor needs to be paid in by April the 15th, June the 15th, September the 15th, and January 15th of the subsequent year. In other words, it is not sufficient just to pay 100% of your safe harbor by January the 15th of the subsequent year. These due dates right here and getting your estimates in a timely manner is part of the estimated tax payment requirement. It's not just the total amount due getting paid in for the full year, it's getting 25% of it paid in on time. And condition B above is false because the safe harbor method is actually as follows: 100% of the prior year tax due, or it could also be 110% of the prior year tax due if the prior year AGI was greater than $150,000. And the second component, which also constitutes a safe harbor, is 90% of the current year's estimated tax due. Okay, next question here. True or false? If you did a Roth conversion in Q2 of 2025 and you had your broker withhold $30,000 on the transaction, that means you will get credit for that withholding for the current quarter as well as all remaining quarters on a pro-rata basis. For example, you would get credit for $10,000 of withholding paid in Q2, $10,000 of withholding paid in Q3, and $10,000 of withholding paid in Q4. Is this scenario right here true or false? And the answer again is false. Going down here to the explanation, withholding is deemed to occur pro rata regardless of when it actually occurs. This right here, by the way, is the same default treatment that the IRS uses for income. Both income and withholding are deemed to occur pro rata. It doesn't matter when they actually occur throughout the year. The default treatment will be to spread them out evenly over the quarters. However, unlike the fact pattern shown up here in the question, the allocation of withholding as well as income is evenly to all quarters, not just the current and remaining quarters. So in the fact pattern described above, the allocation would be as follows: $7,500 of withholding to each quarter. Okay, next question, true or false? On our 2024 tax return, we had federal AGI of $223,212. We had total tax due of $36,482. Our projected tax for 2025 is $47,410. We also have $12,300 of withholding for 2025 and an overpayment carryover to 2025 of $7,854. We also made the following estimated tax payments for 2025. $0 in Q1, $10,000 in Q2, $4,000 in Q3. So with all of that in mind, is it true or false that a Q4 estimated tax payment of $4,000 will be sufficient to cover us from getting dinged with interest and penalties for 2025? And the answer is, just kidding. There is no way that I would expect you to be able to calculate that answer in your head. Certainly not as quickly as we just went through it right there, and probably not at all. So in order to find that answer, let's take our newly discovered fact pattern. We're going to bring that information over to the Number Crunch Nerds Safe Harbor Estimates calculator, and after we use it to determine the answer to our final pop quiz question right here, we will go back and compare the results for Barbara and Bill over here based on their supposed identical Roth conversion situation, where one of them got dinged and one of them didn't. Okay, so let's run through this. I'm right here on the Safe Harbor calculator for this last quiz question. I do have a snapshot right here of the fact pattern, and we're going to go ahead and throw all of these numbers into the calculator. Actually, I've put them in already, but we're just going to walk through it as if we were putting them in for the first time. So starting at the top of the list here on our 2024 tax return, we had AGI of $223,212. There's the $223,212. Total tax due, that's on the prior year tax return, $36,482. There's our $36,482. Our projected tax for 2025 is $47,410. And so right here on the next row, there's our $47,410. We also have $12,300 of withholding for 2025. There's our $12,300 right there. Okay, now switching sides just for a moment, because we do have some data entry fields highlighted in green over here on the other side of the calculator. Overpayment carryover to 2025 of $7,854. There's our $7,854 right there. And then we have the following three estimated tax payments: $0, $10,000, and $4,000 for Q1, 2, and 3 respectively. So there's our $0, $10,000, and $4,000 right there. And the question was, is $4,000 sufficient enough for us to be covered from getting dinged with underpayment penalties and interest in the fact pattern laid out right here? Or perhaps said a little bit more specifically, what is the amount that has to be paid in Q4 in order for us to avoid underpayment penalties and interest under this fact pattern right here? By the way, if you are ever wondering, like, what information do I need to gather in order to appropriately fill out the estimated tax payments calculator, in order to figure out for any quarter, what do I need to pay in order to avoid interest and penalties, this list right here, this is your complete list of everything that you could need. Now, it's certainly possible that you may not have everything on this list, meaning maybe you don't have any withholding, or maybe you don't have any overpayment carryover, or maybe you didn't make any estimated tax payments in any of the first 3 quarters. But regardless of how little or how much of this information you actually have available for your situation, this right here represents the complete list of everything that you would would need to know in order to do safe harbor estimated tax calculations. All right, let's run through it real quick. So right here, prior year AGI, is that number above $150,000? And the answer is yes. Therefore, if we base the safe harbor on the prior year, it will have to be based on 110% of the prior year tax and not 100% of the prior year tax. Okay, there's the prior year actual tax off the tax return. This is the projected tax for the current year. There is our withholding for the current year. Now let's jump down to the calculations. 100% or 110% of the prior year. Let's look at this number, $40,130. What is our expectation? That it's 110% because this number is above 150, and we can certainly see by looking here at 36,482, this number down here is not equal to 100% of this number. And so the calculator is appropriately determining this to be 110% of this 36,482. Then the next line item, 90% of the current year. There's the current year right there. Multiply that projection of tax by 90%, 42,669. Whichever one of these numbers is the minimum, is the amount of full year safe harbor that you are required to pay in. As we talked about earlier in the video, it is not just this grand total that matters, but the 25% allocation to each of the 4 quarters. Yes, you have to pay in the grand total here by the end of the Q4 deadline in total, but you are also required to pay it in at certain installment dates, which are listed right up here at the top. So starting in Q1 right here, there's the amount due for Q1. There's our overpayment applied from the prior year. Our withholding of $12,300 is deemed to occur pro rata, just like we talked about before, and therefore it will be allocated in this example at $3,075 to each quarter. This overpayment underpayment cell right here from the prior quarter does not apply in Q1, so we'll move past that. So we have the overpayment applied plus the Q1 withholding. That gives us $10,929. The amount due is $10,033, and the amount we have paid in is $10,929. Therefore, we have paid more than is due, and therefore we have an overpayment right here for Q1. Make sure to note that in this row, an underpayment is a positive number and an overpayment is a negative number. So we are overpaid for Q1 by $896. Okay, headed over to Q2, we start with the same 25% of the grand total safe harbor that's due for the year. There's our same 25% allocation of withholding. Here's the $896 overpayment from Q1, which is now applying to Q2. The total of these two numbers right here is about $3,900. That's how much we have paid in prior to making any estimated tax payments. So we owe about $10,000 right here for Q2. We have about $4,000 paid in, and so we have an estimate due of about $6,000. However, based on the fact pattern that we saw before, it was clearly stated that the person paid in $10,000 for Q2. And by the way, if you're wondering, does this happen regularly? In other words, do people pay in different amounts than they're actually supposed to? The answer is probably almost every single time. So this certainly would not be an unusual situation. Therefore, we owed about $6,000. We paid in $10,000, and therefore we are overpaid for Q2 by about $4,000. Okay, hopping over to Q3, the 25% of the safe harbor is the same. The withholding is the same. The quarterly overpayment from Q2 to Q3 is this is $3,900. We have about $7,000 paid in. We owe $10,000 for the quarter. That means we have a payment due of about $3,000 right here. In the fact pattern, it was stated that we decided to pay $4,000, and therefore we are overpaid in Q3 by about $1,000. And then finally getting to Q4, where the heart of the question is, we have the same $10,000 here, the same $3,000 there. There's our $1,000 carryover from Q3. We have about $4,000 paid in. We need $10,000 total, which means we are going to need to make a payment right here of approximately $6,000, or more specifically $5,976, would mean that for the full year as of Q4, we are neither overpaid nor underpaid. In fact, we are perfectly paid in based on the fact pattern that we were presented. And so once again, I would not expect you to be able to calculate all of that in your head. That's why we have the Safe Harbor Estimated Tax Calculator that is included with the Personal Tax Planning Template program. Okay, now going over here to compare Barbara and Bill's situation. We're not going to walk through every line and every number because both of these calculators have the same conceptual setup. Everything that has been entered, while it might be a different numerical value, the concept of what was entered is the same, and therefore we're just going to spend our time interpreting the results. So starting with Barbara, she is the person who did her $70,000 Roth conversion in Q4, and then she paid in her $16,800 estimated tax payment, and then she got dinged, and she didn't understand why she got dinged. And so let's take a quick look at the results right here, which we can see just in this bottom row, having nothing to do with her Roth conversion income at all. And by the way, how do I know that this calculation has nothing to do with her $70,000 Roth conversion? Well, it's because I'm looking right over here and I'm seeing that the amount of the safe harbor is based on the prior year. Therefore, her calculation has nothing to do with the current year's income or tax. So if her calculation for the safe harbor has nothing to do with the current year's income, which includes the $70,000 of Roth conversion, then I know that these over or underpayments right here have nothing to do with that transaction. Her entire calculation is based on the prior year amount right here. So with that in mind, let's see where she messed up. So right here, we can see that she's underpaid by $617. She owed about $10.6 for the quarter. She had $3,800 in carryover from the prior year. Her withholding allocation to the quarter was about $6,200. She was just short. She owed a little bit more than she had paid in. She did not make any estimated payment, and therefore she was underpaid for Q1, and that penalty and interest is calculated by the day. So this was outstanding for like basically 9 months. The penalty and interest accrues on this for approximately 9 months, assuming you don't pay it off sooner. But in this situation, it looks like she didn't. So you have this number standing out here working against you for all of Q1 through basically January 15th when she finally paid it. Now in Q2, same situation. She's just underpaid. She owes this. She has this much withholding. She still owes an amount from the prior quarter. So this is now working against her still, so to speak. Like it's not helping like it was in the previous example. It's not reducing the amount owed. It's basically saying that she owes more. So another way to look at that is she had $6,200 of withholding that would have gone against what she owed in Q2. But since she owed $617 from Q1, $617 of this amount went against what was owed in Q1, leaving only $5,587 to go against Q2, and therefore she owed $10,638 less this $5,587, leaves us with an estimate due of $5,050, but there was no estimate actually made, and therefore you have this amount now sitting out here from Q2 all the way through January 15th, accruing interest and penalties on a daily basis. And you can follow the exact same logic right through here in Q3 and then right through here in Q4, but then right here she decides to make this payment of $16,800. And cumulatively, since she had not made any estimated payments and she was continuously underpaid for all of the quarters previously, she owed on a cumulative basis $13,917. So when she paid this, she probably had no idea that she owed this amount. She thought this had everything to do with her Roth conversion. But because she paid in enough to cover this total amount that was outstanding, she paid off everything that was past due, and then she was actually overpaid as of the end of the year. But keep in mind, this is just like a credit card or any kind of debt. Just because you finally decide over here to pay this off doesn't mean that the interest and penalty that was accruing for all of the amount of time that this was outstanding and all of the amount of time that this was outstanding and this was outstanding, all of that is still due. And 9 times out of 10, your tax return software is probably not going to figure that out for you. Sometimes it can, sometimes people just don't fill out the right information, particularly if you're preparing your own return. And so what will happen is just what I described here. She'll know nothing about it for the first 3 quarters. She'll actually know nothing about it all the way till April 15th. And then she'll file her tax return, and the IRS will look at all of this and they'll say, wait a minute, look at all these outstanding underpayments for all these quarters. And then they will send her a notice in the mail and she will get dinged. Okay, now let's do a quick comparison over here with Bill. So the first thing I can see is that Bill's estimate is actually based on 90% of the current year. This is most likely what you would use if you were expecting a significant drop in income. Now you might be saying, yeah, but Bill did a $70,000 conversion too. And you would be exactly right in saying that. However, you don't know anything else about his other income. Maybe he also stopped working. Maybe he's no longer collecting W-2 wages. And so despite the fact that he may have done a $70,000 conversion, you can't just look at that one piece of information in isolation and say, oh, this should happen or that should happen. You have to look at all of the information together. Otherwise, you're going to have an incomplete picture. And that's the entire point of the personal tax planning template, is to lay out your numbers so we can figure all of this out, including estimated tax calculations. By the way, on that particular note, where do you think this number comes from? Right here. Enter the current year total tax projected. Well, this comes out of the 2025 column of the personal tax planning template. What do you guys think we're doing over there? We are projecting what your income tax is going to be, not only for the current year, which is 2025 in this example, but for future years as well, for other purposes. This calculation for 2025 happens to be quite relevant to the Safe Harbor estimated tax calc, and so that's where the link essentially exists between this calculator right here and the tax total at the bottom of the 2025 column within the personal tax planning template. Okay, so going over to Bill's calculation, he owes about $8,000 a quarter. He has about $5,000 of carryover from the prior year. He's got about $6,600 of withholding per quarter. So in the first quarter, he's got about $11,500 paid in. He only owes $8,000. So he is overpaid in Q1 by $3,400. Same starting point in Q2, same withholding. He's got that that overpayment from Q1 carrying over, so he's paid in to the tune of $10,000. He owes $8,000, so he's overpaid by $2,000 as of Q2. Same number there for Q3, same number there for Q3. This overpayment is carrying right up here to Q3. He's got $8,600 paid in. He owes $8,000. He's overpaid for Q3 by $500. And then we have the same starting point here for Q4, same withholding. There's our carryover from Q3. $7,100 is paid in. He owes $8,000, which means he probably needs to make a payment of about $953. But since Bill has no idea what he's doing and he thinks that making a Q4 estimated payment specific to the Roth conversion that he made, not looking at all of his income together, not figuring out what his safe harbor estimates are, just kind of picking a number out of the air willy-nilly, he decides to pay in $16,800. And so is he underpaid? No, he most certainly is not underpaid. He's overpaid by $15,800 in this example. Okay, so what's the big deal? Like, who cares if you're overpaid by $15,000? Well, I've made this argument before and I'll make it again. When we live in a high interest rate environment, and I understand that interest rates are coming down and they probably will continue to come down over time. And the lower that interest rates go, the opportunity cost here probably continues to go down. But as of the making of this video, you can still get 3.5%, maybe even 4%, maybe even 4.5% on cash. And you could probably get a little bit more than that on like a 3-month CD. So this was paid in on January the 15th, and by the time Bill figures out what he did, it's probably going to be already April the 15th or later. He may even only realize what he did after he files his tax return. And so basically, Bill let the government sit on about $16,000 of his money that could have just been sitting in an interest-bearing account earning on his behalf. And so you have an opportunity cost to paying in too much, particularly if you can get a reasonable return for minimal risk. Or, as I like to say, as long as you can get a risk-free rate of return, meaning a return on cash, that is enough to make you just not want to hand the government $16,000 for their own purposes for 3 months when you could be using it to earn interest for your family. That's a decision that each family will have to make for themselves. And so there you have it. That is why Bill and Barbara had the same exact Roth conversion transaction, the same exact Q4 estimated payment, but Barbara got dinged for all of these outstanding payments in Q1, Q2, and Q3, and Bill did not. Okay, let's take a quick look at where we are in the 2025 year-end fast track training. Last week, we were working on step 8 right here, identifying room in the brackets during the sweet spot years. We had also gotten to identifying high bracket taxation in RMD territory. And we also started phase 5, looking at strategies to fill up room in the lower brackets with excess high bracket income from RMD territory. During this upcoming week, sometime between football games and turkey comas, we are going to go over IRMA impact. We're also going to be going over widow's penalty for IRMA. There will be videos coming out in the members area on these topics right here. If you are new to the channel, there is still plenty of time to hop in and get caught up on the fast track training. You still have about 5 weeks to get your conversion calculated and completed before 2025 is up. If you have room in those lower brackets, the 10, the 12, the 22, perhaps even the 24% bracket, and you let 2025 close without filling those up, while at the same time you are on track to get hit in even higher brackets during RMD territory and even higher brackets because of widow's penalty, then you may be genuinely doing yourself and your family a disservice from a long-term tax planning perspective. So if you want to make the most informed decision you can in the quickest amount of time possible, that is what the 2025 Fast Track series has been designed to do. Hop in today and start cranking out those training videos, starting in step 1, 2, 3, and all the way up to where we are today. The complete personal tax planning template and video training, including the Fast Track Year-End 2025 training, is available for purchase in the link in the description below this video. Everybody who joins gets lifetime access for a one-time access fee. My personal tax planning template program is arguably one of the most comprehensive and accessible individual income tax training programs on the market in the United States today. Take a look at some of these recent comments by members of the program. Justin, your videos are so detailed and understandable. Thank you for helping us primarily old school retirees. And over here, thanks again for all your hard work and excellent education material. It is helping me to no end figuring out our future retirement taxes, Roth conversion, and trying different distribution strategies. And right down here, Justin, your spreadsheet is amazing, as is all of the work you've put into the videos within the members area of the personal tax planning template. It's like having a financial advisor report whenever I want for whatever changes happen or that I want to model. And then finally, right over here, Justin, I wish I had paid more attention to the tax implications of retirement when I hit 60, and I have encouraged others to learn from my mistakes. I'm now turning 73 this year and am facing large RMDs. As I said, you can join the personal tax planning template program with lifetime access for a one-time access fee at the link in the description below this video. And that's going to be it for today's video. Thanks everybody for watching, and I'll see you next time.